Hey, everybody, welcome to another Everyday Trader. I make Greg laugh right before we get started. So, Eric Hale with another episode of the Everyday Trader, and I'm joined by my friend and partner, Greg Jensen. What's happening, Greg?
Well, apparently my forehead's getting bigger. I
This
think
means
that's
you're
a nice
smarter. You
way
got
of
a
saying,
really
hey,
big brain up
your
there.
hair's thinning out a little
I
bit
didn't
up
say that. I said, you're look at the positive side of things. All right. So we're here to add another perspective because you haven't had enough on the Federal Reserve decision. So big news. You have to have lived in a cave not to have heard that there was an FOMC decision. And we're actually going to take a little bit of a pivot. We are going to talk about the FOMC. It's very important. And I think it's a fair question for everybody listening to us to ask the question, why? Why does this matter? Why is this important? And Greg and I have been talking about, trying to use this as a vehicle to communicate that to people. What should you be focusing on and why? Why does it matter? How does it affect your portfolio? And there's some significant stuff coming up that we want to talk about. I mean, first, I'd like to get your reaction and thoughts on the Fed meeting that, Chair Powell had the press conference yesterday.
Well, there really wasn't a lot of new commentary out. It was a very similar statement, other than I would say that they have reiterated really what Chair Powell's been saying for quite some time, that the economy's doing good, that inflation seems to be coming under control. They're still data dependent on that. And the employment situation is pretty solid. And I guess one of the things that my takeaway is that Fed Chair Powell, I believe, reiterated to the market pretty clearly was, just because the market is used to having the Fed funds rate at 0% doesn't mean we have to go back there. In fact, you could make an argument that if we do go back there, it would cause a lot of problems. It's okay to have a Fed funds rate at 5%, as long as we have employment and people are working, as long as the GDP is, as long as we're not in recession, and as long as inflation is under control, which, to be honest, all three of those things seem to be happening. I think that was my general takeaway from the meeting, is that they feel like they're accomplishing what they set out to do when they started raising rates and trying to control inflation. Of course, they're going to have to continue to be data dependent, but I think you see that when you looked into the dot plots, right? That was what really everyone was focused on yesterday, is the idea that the dot plots gave this message that although the Fed's not going to go up much more in raising rates, that they're also not going to start to come back down either, really, anytime soon. And we're talking a couple of years now, potentially, before we start to see the Fed funds rate come back down towards that 2.5%. And yeah, you can see that here with these dot plots, that it was a notable shift up, that maybe the market is finally accepting this idea of higher for longer with the Fed funds rate.
So just to clarify, what are the dot plots? Every 3 months, there's a thing called the Summary of Economic Projections. So everybody who's a participant in the FOMC provides a summary forecast of where they think a number of key economic indicators are going to be. One of which, of course, is probably the most important one, is the where the Fed funds rate will be. So this is the current report. This is last quarter's report. It's a little bit funky because I stretched the scale, but I wanted people to be able to see, compare, and contrast. And what you've noticed is just a subtle shift upwards. So this is where it was, and this is where it is. So there's a subtle shift upwards in where the Fed is going to be. And from this, you can extrapolate that the committee overall believes that there will be a 1/4 point hike, most likely in November, potentially in December of this year. And, there's a big question of why this matters. First of all, it affects inflation, right? And it affects the economy. And the Fed's job is to try and right now put on the brakes and slow things down. And ideally, they want to do it without causing a recession. And I have to say, they've done a phenomenal job. You and I were talking ahead of time that really Goldman Sachs was the only institution that was out there saying we're 25% probability. I think they're down to 15% probability of recession in the next 12 months. And they were an outlier. It was like 80% of all institutions or some high number like that pretty much had that we were going to have a recession. And we're going to talk a little bit about what is a recession and why it's important. So the Fed funds rate is important for a couple of reasons. One is that it affects the economy and it slows things down. And that's what we're trying to do without stepping on the brakes too hard. But this ever important Fed funds rate pause, or it's not a pause. It's when they end, when they're done raising rates. So a lot of people are asking for a cut, and I think we shared this in the past. When the Fed cuts rates, the S&P 500 tends to do very poorly. And this goes back to answering the question why. Why do we care about the Fed funds rate? So there's some data that was shared, and this came from Bloomberg. This is the performance of the S&P 500 before and after the last rate hike. So here would be the last rate hike, and this is the average of stocks where there was no recession, and this is the average of stocks where there was a recession following the last rate hike. So if we are going to go into a recession, one could expect in the next, this scale is a little bit funky. I think these are days. So that's like 6 to 7 months. It's kind of weird, but it's not a full year. But anyways, roughly, we're almost equally down or up. So the question is, when the Fed pauses rates, the next big question is, are we going to go into a recession? And history doesn't repeat, but it tends to rhyme. By the way, this slide, I'll give credit to the Daily Shot. It actually came from Bloomberg, but the Daily Shot reshared it, and I subscribe to Daily Shot. I do recommend them as a newsletter. They're a lot of fun. They have some really great graphs and stuff to look at. So anyways, I'm just pointing that out. So this is why it matters, is when the Fed pauses, when there are, I should say, not pause, done. So a pause could be a skip, or maybe we're going to raise rates later. When they're done raising rates, I think it could be a signal that the market's going to run higher. And that's what people are asking. When's the last rate hike? And what do we look at? And this is very much factoring into my personal decisions on how I'm trading the market. Your thoughts on this?
I think this goes back to the hard. I liked your analogies that history doesn't repeat itself, but it often rhymes. We do see patterns in the market, and that's why we look at this stuff. To answer your question, why does this matter? Why do I care when I'm making a decision whether I should invest in Nvidia or not, or Apple or whoever? This comes back to the fact that most stocks follow what the overall market is doing. It's very rare to have your company that you own shares in to perform the opposite of the S&P 500. Most of the time, that it's going to drive with the market. So it is important to do big picture, fundamental macro analysis when making your decisions. So that's why we do this. That's why we spend so much time with this. Helps us make a better decision. So my take on this is, I'm still concerned about, I'm in the camp that we're not going into recession either. And the reason why is I think the yield curve is still too inverted right now. We're at the deepest level in the history of the 3-month 10-year that's been inverted. Now we're off the lows, and y'all know that when it does finally go back positive, when we have the 3-month not yielding more than the 10-year, that's when the potential recession starts to happen. We're not even close to that. And the unique situation there's a perfect example of that on the chart right there. The unique situation that we're still in, that right now, where it's hard to get bearish this market, still comes down to the fact that there's still so much liquidity. chasing equities, chasing risk assets. And if the Fed can do what they're doing by controlling inflation and keeping the employment situation there, keeping the GDP growing, maybe we don't go into recession. Maybe we I don't know, Eric. I think we are still in unknown territory. I
So
still have,
by the way, you say liquidity, it's a fancy word. And I'm guessing that, a lot of our listeners probably understand what that means, but I'm sure there's a fair number of people who don't know what does liquidity mean?
money.
Money. There's
Just
just a
the
boat
vast
ton of money.
amounts
There
of
is a
money.
mega shit ton of money
Yeah,
that's out there, right?
there just really is. I mean, the amount of money that was printed both at the Fed level, but even more so what Congress did to help us get through COVID when we shut down, and then the paychecks that showed up and they either got put into savings accounts, they got put into checking accounts, they got spent, they got invested into the market. That money got put to work somewhere. It got put into property. All of those things that cash is still there. That's what the Fed's trying to pull back out to slow inflation down. And they've been doing that a little bit.
This
And by
is
the way,
dollars. This you can think of liquidity. This is that Fed balance sheet. This is updated weekly. This is just how much money is out there, how much cash is flowing around. And Greg's point is liquidity is available. We're coming down. They're lowering the balance sheet, and that's great. We were up near almost $9 trillion, and we're down to a little over $8 trillion, $8.1 trillion. There is just a ton of money that's out there that has to go someplace. And a lot of indications are that this isn't going away soon. There's other measures. We talk about the reverse repo sometimes. That's important. Another measure of how good liquidity is. So good point, Greg, that you're looking at that. I wanted to pivot back to recession here. And so first of all, why did we look at the Fed funds rate? Because the Fed funds rate is important. When the Fed funds rate pauses, we can expect certain behaviors. If the Fed cuts, I would expect the market to be bearish. If the Fed pauses or stops raising rates and we don't have a recession, we talked about this previous chart here. So it could be good or bad. So we want to ask about recession. And just to back up, there's one other thing. Some people are listening and say, well, you guys talk about inflation all the time, talk about CPI and PCE. And we look at that because we want to know what the Fed's going to do. Right now, employment isn't as important because the Fed has one mandate, that's get inflation under control. So we look at the CPI, PCE, and other inflation metrics like the PPI as well, in order to understand what the Fed behavior is going to be, where the Fed is going to go. And these guys don't have a crystal ball, and sometimes these plots are off. So that's why we look at inflation. But there's other indicators that we look at too. And this is from advisor perspectives, which is now part of Edify. This chart I like to look at, and determining when we're in a recession. So it's the NBER, National Bureau of Economic Research. It's a federal government agency that determines we are in a recession, we're not in a recession. They're the ones that when we look at these gray bars, you see a gray bar here, that gray bar is a recession. So they're the ones that make the determination of we're in a recession, we're out of recession. And it's a bit of a mystery as to what they use. But economists believe generally there's four things that go into indicating a recession, and that is employment, industrial production, real retail sales, which takes into account inflation, and then real income, which also takes into account inflation. And we can see how these numbers are trending. If you go back in history, when they're all red, we tend to end up getting into a recession. So right now, this is another reason why we look at the economic indicators. We talk about these employment, industrial production, retail sales, and real income, because these are the indicators that are going to tell us whether or not we have a recession coming. And then it goes back to this important graph: is no recession, the market's probably going to do better.
Yeah, and I think what's important about that graph right there too, if you go back to the other one, Eric, that's a 6-month window, basically. It's 184, maybe a 7-month window right there that you're talking about. And it's a potential 15% move on average from 1971. Again, this is taking in 50 years of data. That if we don't have recession and the Fed's done raising rates and we're not into recession, That's a 15% move in 6 months. That's huge.
It's a big move.
Now,
And again, that's the median since 71. But we're not the only ones looking at this. I mean, this is what the Goldman Sachs, Bank of America's, Morgan Stanley's, all of these, JP Morgan, this is the stuff that their economists spend a lot of time looking at. And it's the same thing that trickles down into, your recommendations for what to trade from if you have an investment advisor. That's the sort of thing that makes forecasts. So we're just trying to help everybody here get a step ahead of that and do your own research. But there's another thing about coming up here. So we talked about September being the worst month, historically the worst month. Still not sure if that's the way the month is going to play out. It's still yet to be seen. Ooh, we got a really big down day today. Here's the S&P 500. So far we're negative for September. Yeah, so it's playing out that it's going to be another bad month. But there's something particular about October, right? What about October?
Halloween?
Yeah, Halloween.
No. Sorry, I apologize to all of my fans out there. It's playoff baseball.
Oh my goodness. And the Cubs are they were below 500 a few months ago. And then all of a sudden they have just turned on the heat. But I don't think they can beat the Dodgers or Atlanta. I don't know.
Dodgers, I was going to say, I don't think the Dodgers are even the team to beat. Atlanta's good.
Atlanta. We'll see. It's down to the wire here. We might be we're in the bid for a playoff for a wild card. It's going to be down to the wire here. So leave it to the Cubbies but at least we're not mathematically eliminated by July.
Right.
Being a long-term Cubs fan, had a long period of time of that happening. Anyways, so October, baseball season is in play. There's also another important thing. This is some research shared by Goldman Sachs talking about the volatility of the S&P 500 and the NASDAQ. And here we can see that there's one of these that's head and shoulders above the rest of them. October September tends to be the worst month. October tends to be the most volatile month. So realized volatility is the sort of another way of talking about it, or we talk about it as synonymous with historical volatility, the volatility of the stock. This is not the VIX, although the VIX tends to go up. And that's the other thing that's happening right now is we've got the VIX pretty much asleep. I mean, it's pretty darn low. Let me pull up a chart of the VIX here real quick. We've got there we go. Today it woke up. That's why you've been doing that. There you go. So we got the VIX spiking back up, and just a few days ago we were down in the low 12s, and now we've got a VIX up at 16. So we should have done this presentation 3 days ago. It would have been a little more apropos, especially with the big move up. So the VIX has woken up today, and I don't think this is just the beginning of what we can expect. You'll see people talking about VIX seasonality, and that is referring to how the VIX tends to behave depending on the different month. And we see this is the volatility of the actual volatility of the stock. Subsequent with that, we'll also see the VIX going up, which means option premiums will go up. Right. I mean, today we are getting a big move in the VIX. I think it might subside. I'm going to keep an eye on it over the next couple of weeks. But I do expect it to be higher in October. Your thoughts on that?
I do too. I mean, October has its bad reputation for a reason. We've had some really big down moves in October. And I think one of the things that Goldman, like you said, was talking about is the fact that options, even though the VIX is at 16 and options have gotten a little more expensive, maybe some protective strategies in the short term to get through this month might make sense right now. Also considering there's another big economic, maybe I won't call it economic, considering it's a political event that can become economic that may or may not cause some.
Come on, you're being vague. Just say it.
Something about a shutdown in October, and politicians having to agree on something to avoid a shutdown. I think the only thing they usually agree on is let's kick the problem down the road. And that's what they did before. We're now back to we just kicked the can down the road, and we have to decide about shutting down over government budget issues again. I saw a piece earlier today on Twitter talking about the probability of this shutdown happening is actually upwards of 80% right now.
So should we panic?
Should we panic? To be quite honest, no, because it really doesn't do much to the S&P. There was a really good piece by Sam Rines talking about what the S&P actually does during the shutdown, 5 days before and after the shutdown. And to be quite honest, it doesn't do much. There was a little volatility in 2018 and 2019 with that shutdown right before the shutdown happened. But once the shutdown happened, I say a little bit of volatility. I mean, we dropped 200 points when the S&P was at 25. We had a 10% down move before the shutdown.
Buying opportunity.
But he ended up being a huge buying opportunity because, a month later, we're back above the level where it was previous to the shutdown.
So the blue line is the shutdown. So the blue line is the shutdown, and the gray line is what's happened before and after that, 5 days before and after the shutdown. And so this is again from Sam Rines, who was an economist for Kurbu, and he publishes one of my favorite newsletters called Polymacro. And you can count on Sam to look at something different. I think Sam pays attention to the news about this much because, well, you'll read him in the Wall Street Journal and the Times and other places because he's on Bloomberg. There's a really phenomenal Joe Wiesenthal and Abramson, what's her name? Sarah Abramson podcast, Odd Lots. So there's an excellent one with Sam on there. And Sam's really a forward thinker, and he's looking at different things. So everybody's talking about this government shutdown. I think Sam's words, and he might have been watching Tom Keene, called it a nothing burger. Didn't Tom Keene say nothing burger on the?
Yeah, no, that's one of Tom's words for sure. Yeah. Nothing burger.
Yeah. So this is so if there is a shutdown, it will have some impact though. One of the things where it's going to impact is we won't get any economic data. So it's quite possible that we don't get any employment data or any of the other economic reports that come up from the .gov agencies. So we'll be flying in the dark a little bit on unemployment and inflation and some other data, depending on how long it shuts down from. But historically, those jiggles do tend to recover. And by the way, we talked about October or September being the worst month and October being volatile month. Greg, I attribute you with helping me to realize this volatility is not always bearish. We can have volatility to the upside. So
yeah, that's right. Volatility to the upside's fun.
Yeah. So we could have a step up. So thinking about, maybe either protective strategies or opportunistic Vega positive trades that benefit from an increase in implied volatility towards the beginning of October might be something to take a look at, keeping an eye on all of these things.
And if you're sitting on a lot of dry powder, like I am right now, I'm actually sitting on a lot of cash right now. I let a lot of covered calls get called away in July and August. Maybe, you look at, maybe we get a government shutdown in October and it creates one of these volatile moves to the downside. That's going to end up being a great opportunity because I believe, how we started the show today, I believe we're not in recession. I believe I'm not of a belief that the Fed has inflation under control yet, but in the short term, I don't think they're moving on interest rates to any more to the upside unless data really comes out screaming hot in the next few months. But I believe the scenario that creates for the next several months, probably through the end of the year, is we could have a rip your face off rally to close the year out. There's a lot of cash to chase assets right now. We seem to have controlled the inflation demon in the short term. So I think the markets could get hot at the end of the year. So if we do get volatility from a government shutdown, I'm a buyer for sure.
That's interesting. I'm not as bullish as you, but I'm not bearish. So I'm stagnant to bullish for the rest of the year. I have been doing a lot of actually a lot of delta negative, theta positive trades. So stagnant to bearish trades over the past week or so. And like you, I had a lot of positions closed through assignment or whatever, sold stock positions, and have a lot of cash on hand right now, which is playing out nicely for setups in October.
Yep. Okay, well, we'll see what it brings.
What's that?
I said, we'll see what it brings.
Yeah. So thank you for taking the time to listen. We can't seem to do one of these in 10 minutes. I know that the Snapchat crowd wants 30 seconds, or is it the TikTok crowd out there wants 30-second videos? We can't seem to do that. So for those of you that can endure, what probably was this 30 minutes, however we've gone, about 30 minutes. Hopefully you got something out of it. Please ask questions, leave feedback, share it with your friends. Go ahead and, tell your friends that, hey, check this out. Love to get your feedback and questions, and look forward to seeing you again.
Thanks, everybody.